Okay, I think we're good to kick off for now. Good morning, good afternoon, and welcome to Solving SAF's three biggest challenges, where our panel will be exploring what airlines, developers, and the North American market really need, from cost to bankability and technology pathways. Thank you all for joining us today. My name's Roz. I'm the Content Director for SAF North America Congress. Sustainable Aviation Futures hosts a global series of high-level aviation, decarbonisation, and SAF event conferences, bringing together the entire value chain to network, connect, and discuss the capabilities for scaling innovative energy solutions and powering a thriving aviation industry. Over the next 60 minutes, our panel of experts will discuss how airlines can confidently navigate rising SAF costs, supply uncertainty, and mounting pressure to decarbonize, how developers can align around investor expectations, and which technologies are best placed to scale in the short and medium term. The webinar is being hosted ahead of the SAF North America Congress, which is taking place in Houston in just under a month, from the 14th to the 16th of October. Today is going to provide a snapshot into some of the topics covered at the event, which will also include all of our speakers today. And it's also supported by King & Spalding, Axons, Zero Petroleum, and World Energy. So thank you all. The three-day event features over 700 senior leaders and industry experts from across the entire aviation and energy value chain to discuss announced SAF projects and exciting offtake agreements in North America, the path to meeting the industry's ambitious targets, as well as the global SAF landscape and other innovative energy technologies. If you'd like to keep abreast of all of our upcoming events, as well as gain access to exclusive interviews and articles, be sure to subscribe to our monthly newsletter, SAF Spotlight. And before I hand over to today's moderator, just a couple of bits of housekeeping. The session is being recorded and will be distributed to everyone once the webinar finishes, probably within the day. So if you have to leave for any reason, you won't entirely miss out, but you might miss out on the Q&A. Furthermore, there is a Q&A at the bottom of your screen, so please ask any questions that you have in the chat box there, and we'll do our best to answer them all. And with that, I'm very pleased to hand over to our brilliant moderator, Amina Daman, partner at King & Spalding. Amina, over to you.
Thank you so much, Ross, and good morning, good afternoon, everyone, depending on from where you're dialing in. My name is Amina Daman. I'm a partner with the law firm of King & Spalding. I'm located in Austin, Texas. My specialty is being an environmental lawyer, and one area of expertise is EPA's Renewable Fuels Program. I'm very excited to be moderating the panel today. As Ross mentioned, we'll focus on three challenges in the SAF industry today: on cost, on bankability, and on technology pathways. And with me today are four very esteemed members of the SAF industry. And I'm going to ask each one of the four to briefly introduce themselves. I'm going to start with Adam. Adam Clover, please go ahead.
Thank you, Amina. Yeah, it's great to be here. I'm Adam Clover. I'm the Vice President of Sustainability and Digital Supply Chain for World Energy. World Energy is a SAF producer and has operated the first plant that was a commercial scale for sustainable aviation fuel. In my role at World Energy, I help to make sure that our customers have all the information for tracking and trust for transfer of credits. And we often cover our Scope 3 customers, so the end customers of aviation, of airlines, the corporate passengers, and corporate air cargo customers.
Thank you, Adam. With that, I'm just going in the order of my titles here. Jeff Benish, you're up next.
Hey, good morning, everyone, and good afternoon to our European colleagues. My name is Jeff Benish. I'm the Chief Operating Officer at Zero Petroleum. At Zero, I'm our I lead our long-term project roadmaps and long-term business planning. Within Zero, what we do is we are actually a technology developer in the Fischer-Tropsch space, and we're distinctive in actually producing true Jet A replica, high-performance gasolines, diesel, and hard-to-abate chemicals such as aromatics, polypropylenes, and other critical feedstocks for the chemicals industry. And as such, we're both developing projects and then also developing a technology that is licensable for others going forward.
Thank you, Jeff. Then next up, Michael Obershin. Please introduce yourself.
Good day, everybody. My name is Michael Abishon. I'm the founder and president of Saffron Consulting, a Dallas-based consultancy focused on bringing together sustainable fuel producers and end users with a specific focus and experience bringing together SAF producers and airlines. Last April, I retired from Southwest Airlines after 25 years, where I had experience in corporate real estate. I was an in-house lawyer for Southwest for 11 of those years. And my last gig was leading the fuel strategy and management team, a team responsible for managing all of Southwest's physical jet fuel, including SAF. The focus of my final years at Southwest was introducing SAF to the company, including all SAF offtake and investment opportunities, including Southwest investment into LanzaJet, where I was honored to serve as a board observer. I look forward to engaging with you all today.
Thank you, Michael. And then last but not least, David Swalje.
Hey, everybody. Dave Swalje. I'm Vice President of Emerging Market Development at Axens. For those not familiar with Axens, we're a technology developer, and specifically here in the SAF space, we bring de-risk technology for most of the pathways. That's HEFA pathway, alcohol to jet, and also Fischer-Tropsch, which of course includes e-fuels and have partnership to bring gasification. So let's say in the tech space, quite well-rounded. And what does our emerging markets group do? We focus on commercializing our new technologies. So a lot of that is SAF, as you can imagine, and a broad focus there around the policies, the project development, technology development. It's kind of that big picture. How do we commercialize new things?
Thank you, David. So with that, let's dive in. As I mentioned, we have three sort of topic areas. We're going to start with the first one, which relates to cost. And more specifically, what is it that airlines need to do to navigate the rising SAF costs? What are some supply uncertainties? So I'll hand it over to Adam first, if that's okay to get us started on that topic.
Thank you, Amina. This is a really critical piece because addressing the cost will help to unlock new supply. And World Energy believes that insets are a critical piece of the puzzle. So insets are the credits that are associated with an intervention or emission reduction within the same value chain. So if you deliver SAF somewhere in the world, we could have a customer in any other place potentially get the credits for that and be involved with making that supply occur. And because it is expensive to develop new technologies, and we're competing against the conventional fossil fuels that have been around for over 100 years, it's going to take us a while to drive these costs down. So this is a critical phase in which the voluntary market can complement those regulatory regimes in regions where there's going to be deliveries, that those are going to be mandated. But we think that aviation needs to go faster, and there needs to be ways to address that premium. So airlines alone cannot shoulder the burden of the cost in the voluntary market. We think the corporate customers buying the insets to cover their own emissions budgets are critical. So this is an area that World Energy strongly believes is important. We understand that there are now customers that are waiting to see what happens with the regulatory bodies or what happens with the standard setters, like the Science Based Targets Initiative. And we understand that consideration. We've seen movement in the right direction, where the standard setters see in aviation, we need something called book and claim. We need to enable these supply chain participants and value chain participants to purchase the credits without actually receiving the deliveries. And the corporates are a key driver in this. And the book and claim community has been an important standard setter too, which is run by the Smart Freight Center, RMI, and now the Roundtable on Sustainable Biomaterials. And so are buyer aggregation clubs, such as the Sustainable Aviation Buyers Alliance, which I helped to co-found. That is also playing a critical role to scaling up the trust in these systems and providing a momentum so we can grow corporate purchases for SAF insets.
Thank you, Adam. Jeff, when we spoke ahead of this seminar, you mentioned sort of in your mind 3 levers that are important to consider as we're talking about the cost topic. Could you tell the audience about those?
Yeah, absolutely. So I think it's really important to think about this from a long-term perspective, sharing the risk and rewards, and then understanding that right now it is a balance between a corp dev or R&D motion, not just fuel procurement. I think as Adam mentioned, this is a long-term shift, and we're trying to accomplish in a few years what has taken over a century to develop in the fossil fuel industry. Now, the good news is that whereas fossil fuel reserves are basically 4 subregions have more than 70% of the world's oil reserves, renewables are available everywhere, nuclear power even more so. And so I think we do have the opportunity to create a new industry that is more locally based with greater energy resilience. The second part is really sharing the risk rewards. This is an area where we have seen several of the airlines, some of them represented here, like with Michael, where airlines such as IAG, United, American Airlines, Southwest, Delta have been really, really good early participants in the market to make some early investments and support the growth. At Zero, we also work with Airbus, Boeing, Rolls-Royce on the engine side to actually help identify what are the ways in which airlines and OEMs can participate in starting the market. This is how you start to think about this as an R&D activity as well as a fuel procurement activity. In R&D, it's about creating options for future value. And that's why I think it's really important to think that this is a role here for fuel buyers, that you have to evaluate this not just from what are you going to get next year or 3 years from now, but how do you also use option theory to create the opportunity to source fuel over the next 10 to 15 years.
Thank you, Jeff. Michael, your name was mentioned as someone who has worked for Southwest Airlines for many, many years. Would be interesting in hearing your perspective.
Sure, Amina. I think at the outset, what you're going to hear, and I'm sure the SAF producers on the call will have heard many times before, is there is from every airline you talk to going to be a parity expectation with conventional jet fuel. Now, the trick with that is how airlines define parity. You're going to get a different answer from any airline. If you get an answer, you're going to get a different answer from any airline that you talk to. With airlines that have more of an international footprint, there might be more of a willingness to consider in that parity question, things like mandates and that really have to be factored in when you're considering the delta between the cost of SAF and the cost of conventional jet fuel. If you're looking at airlines with more of a domestic U.S. focus, you're likely to get more of a strict, SAF price compared to the price of conventional jet fuel. Adam's point on corporate customers, obviously it's a very important tool, especially in the near term, to close the gap between the cost of SAF and the cost of conventional jet fuel. But I think everybody recognizes that it's not an infinite source of funding to close that gap. So we need policy. We have policy in place to promote SAF and to help close the gap between the price of SAF and the price of conventional, but we need even more credit support both at the state and federal level to close that gap. And we also need a regulatory regime that doesn't put an undue burden on the acceptability of certain SAF types, while respecting the fact that we're all in this business to make sure that certain sustainability criteria are met. Otherwise, the fuel isn't sustainable. Aviation fuel, but like things like geographic limitations, they can be important policy levers for a domestic SAF industry. But we also have to remember that you can really bolster U.S. SAF production. The focus of this webinar is on North America. The U.S. in particular has the opportunity to be a major player in the production of SAF. So we need policy in place that would allow for that. So that's basically, the point that I would like to make around cost. But overall, from an industry perspective, you're going to get different interpretations of that question depending on which airline you talk to, and I know that can sometimes be frustrating.
Thank you, Michael. David, I know the cost question is a hard one, but Michael raised the point of, do we need federal and state support? So I'd be curious in hearing your view. Is there enough of that? And I guess as an initial premise, do you agree that we need policies, that we need the support for both the federal government and state governments?
Well, I'd say, as a technology provider, we really tend to focus on, let's say, those technology aspects, the de-risking part. How do we ensure a few things we're going to talk about later, bankability, et cetera. Clearly where policy is helpful in any new industry, emerging industry here, where we've said it, there's a gap to close. And I'll just say things that are fairly obvious, but I think the more we say them, the more valuable they are, which is when a policy is in place, whatever that given policy is, just clarity on how to actually use it is important. The lifespan of that policy is important. So you just really need the stability. And again, as a tech provider with many different pathways, what we see also on the policy side is that some policies tend to, whether purposefully or not, choose pathway winners. And that's something that, we feel really strongly. Again, we have multiple ones, so we don't want to pick one ourselves. But it's that from a feedstock side, any given policy may have something that's important to them, and you can name a long list. We won't go through them. But on the feed, okay, this is important. And then on the how do we value emissions, this is important. But then letting technology companies, project developers say, how do I get there? How do I use the feeds that qualify or are valued X, Y, and Z way to get to the product, which is as long as it's on spec. That's what we'd advocate for, is the policy not pick pathway winners and losers. Let the market, let the project developers and the technology companies figure out the best way to get there.
Thank you, David. And I may actually just stick with you because you mentioned our next topic, bankability. So here the question is, what do bankable SAF projects have in common, and how can developers align around the expectations that investors are going to have? How can they mitigate risk? And I know, David, you have some really interesting thoughts here, sort of some lesson learned on project development, some ideas about how insurances can maybe play a role and help, and also thinking about sort of diversifying risk, like what's the role of byproducts. So if you mind, I'll stay with you and have you talk us through your thoughts there.
Okay, that's perfect, Amina. You said a key word there, I think, which is expectation, managing expectations. And this is very broad. It's in fact for project developers and technology developers. It's for all of us in this space, which is you've got folks who can and are producing SAF today. For example, World Energy Atom. They can make that molecule, they can place it in the market, and they well know what was the capital it took to get there, what's the cost structure, what do we need to have a return on investment for us? It's well known. They understand it. And then, of course, there are so many technologies and projects that are in development, looking to bring new SAF molecules to the market. And you mentioned, Amina, they're in some ways a cautionary tale, in some ways it's managing expectations. It's that every technology, every project developer along the way is aligning stakeholders, let's say. And those stakeholders may be investors, they may be their own people, their own management. It may be an offtake partner, it may be scope 3 partner. You can name a long list of them, but every project is a long journey and every technology development is a long journey. And of course, keeping stakeholders aligned and engaged is really important. There are a lot of chickens and eggs there. So what we would say as a cautionary tale is, when each project technology starts that development journey, there is such an optimism. We are going to cut the cost by X, by Y, and we have X, Y, and Z advantages. And our return on investment is going to be, I'm just going to make up a number, 35% return, and life is good, and we are the best project out there, or the best technology out there. And of course, these things are the drivers. They're important. But why I mentioned expectation setting is that it is a long journey. And I think some cautionary tales is you can imagine that there's a lot to learn along the way when you're developing a technology or a project. Usually, the cost structure does not go down. It usually goes up along the journey. We love everyone that goes down. Of course, we're all striving to do that, but the general trend is that it goes up. So, I say the cautionary tale, you can imagine that if project or technology A is fully mature, fully baked, ready to go, they know everything about their cost structure, and then project B is early in development. If project A is at the market with stakeholders, investors, airlines, off-takers, scope 3, everybody, and they say, here's what it takes to make this project viable. And then project B is, well, hey, look at mine. This one's shiny. It's going to have a return of this. You can imagine there's a gap there generally. And if you're a stakeholder, again, name them, investor, off-taker, airline, whatever it is, having a B that looks like it does is very exciting. So you can say, oh, well, I'll wait. A is there, it's ready, but man, B. And as we're developing this here, we need a lot of molecules to meet all the targets that everyone has. And that B is likely going to come up somewhere towards the A. Again, there are reasons that innovation, we need that. So we don't want to say that the gap completely doesn't get closed. But just about, let's say, key term there is anchoring expectations. I think that's a really important thing for all the stakeholders to say, here's where we are, here's what we don't know, here's what we're going to do to get there, and let's anchor our expectations somewhere in reality, and then we work towards it. And as we get better, we all endeavor to make it improve. So I'd say, one of our projects has a good term that might be something to keep in our minds here, that he likes to anchor the expectations and keep some cookies in the cookie jar. To say, hey, we have some things we haven't told everybody just yet. We know they're there, and if we need them, we're going to pull the cookies out. And that's a good way to, let's say, keep things moving and have those mature projects and technologies really start to make molecules in the market.
Thank you, David. Jeff, do you want to add to that? I know you have some great thoughts on bankability as well.
Sure, absolutely. And bankability is an interesting one in which banks are both suppliers and customers to the process. I often tell people that my job is not just a trifecta of challenges, it's a pentafecta, which I have to bring together in any given project: the technology, the site and feedstocks, the customers and policy, the engineering, and the banking. But really, banks are a customer of the process. And I think it's really important that we think about, as project developers and technology developers, what is it that a financial customer wants to see in a project? And there is a very deep analog. I started off as a petroleum engineer. There's a very deep analog in what we do in the midstream oil and gas industry. And a lot of times the financiers for our projects are evaluating our projects by those metrics. Those metrics include certain things around revenue certainty, project IRR, debt service coverage. And so I would say to all of my fellow technology developers out there, really try to take some time and get coaching and school yourselves in midstream oil and gas financing, because that is fundamentally a similar investor to who we need to engage in projects to get them to be bankable. The second part about bankability is ultimately bankability and financing is a bridge between project cost and customer price. And I think a lot of us right now see that there's actually a lot of friction between those. The fossil oil and gas market is very efficient. Basically, if you think about it, you can get oil and gas from almost anywhere in the world to any customer in the world for a few percent transportation cost and a few percent commodity trading cost. However, right now in the SAF space, we're at an unusual situation where it's highly speculative and highly uneven between supply and demand. And right now we see fuel services providers who are often taking 20 to 50% friction
Thank you, Jeff. Adam, I see you're back. We're on the topic of bankability. I know you're involved in a number of organizations, including the RSB. So the question to you is, what does bankability even mean? What are criteria we should think about when we talk about bankability?
Thank you, Amina. Yeah, and apologies for my computer reboot and all of the screen sharing that happened. So around bankability, World Energy is sponsoring 2 projects that will soon have public reports. The first is with the Roundtable on Sustainable Biomaterials, and that is part of their impact indicator work. It's called the Market Acceleration Indicator, and it's how do you certify a contract as bankable and then create some of these areas around that. Demonstrate to others that what you're doing is additional and that you, as a customer, have signed on to a contract that's going to unlock more supply. The fundamentals or the 3 most important parts of what makes it bankable are contract duration. Right, ideally, a contract lasts as long as the project, which we've seen in the solar and wind markets. So if a project is 20 years, ideally you have a long-term offtake that's of similar time frame or 10 years or more. The other is how binding is the contract. So is it a take or pay? Is the customer required to take the product if all the other conditions are met? So much stronger than an MOU. And then third, creditworthiness. And this is where the corporates really do have a place to play. If they've got a high credit rating, they will be seen as lower risk from the banks. And that is a critical component in a way that they can complement what the airlines can't provide. One fourth area also for consideration is how to address price risk volatility. We know that government incentives, they go up and down. The fossil price of jet fuel goes up and down. And if there's a way to address that with a contract for differences model, cost plus, revenue certainty is something that is also being looked at in the UK and may have other applications. So addressing that area. And one other project that is worth mentioning that helps stakeholders build these contracts is something called the Bankability Playbook. And RMI, again, working with Microsoft and with World Energy, is putting that out, and that should be out sometime in October, which will help the counterparties create these contracts that will meet these requirements of these pillars.
Thank you, Adam. Michael, you provide this unique perspective from the airlines view. So curious to hear your thoughts on bankability.
Yeah, I really think I mean a lot of it has been covered. I was nodding during everything that Adam was saying, because really I think at the end of the day what you're talking about is from an airline perspective is that like having a bankable offtake agreement is going to be super important for any airline investment. For example, into a SAF producer would require ultimately a bankable offtake agreement. what does that mean? I think will be a matter of negotiation, right, between the SAF producer and the airline. But I think that Adam covered off on a lot of the elements there that would have to be considered, including contract duration. Some airlines might be willing to have longer term offtakes, some might not. And so I would contend, like for a SAF producer, obviously having a longer term offtake agreement would be more preferable and would make that more of a bankable offtake, for example. Also, it's interesting that creditworthiness was mentioned, because I do think some airlines are more creditworthy than others, right? And so I think bankability also could an offtake agreement or could be more or less bankable depending on the creditworthiness of the underlying airline or airlines, or potentially even a consortium of airlines. So I think that is something that certainly needs to be looked at as well. And then just finally, he talked about the price risk volatility. Really, who takes the risk of certain credits being in place at an amount and duration over the life of an offtake agreement is going to be a huge point of negotiation, and always is in these deals. So that would be my point of view on bankability from an airline perspective.
Yeah, thank you, Michael. And David, I wanted to circle back to you. There were a couple of other items that you could touch on. One relates to the role of insurances, and the other one is sort of this aspect of how can we diversify risk, and especially in the context of SAF production, maybe think about utilizing any byproducts and using those to diversify risk.
Yeah, that's perfect. I mean, as the others were just talking here, I was nodding my head and thinking about, of course, yeah, the team has mentioned some of the risks inherent to the SAF molecule itself and the associated emissions abatement. And one of the things, when you look at the overall bankability of a project, you can imagine as an investor, or let's say a financial stakeholder of some type, debt or equity, you say, hey, if all my product is SAF, then I have to really understand all those risks, and that's how I have to evaluate this project, all on those SAF. And it's not saying you can't do that, but that's just the nature of if you're making all SAF. So one of the things we've seen in projects that really keep some momentum is, how do we diversify our co-products? How do we they'll all have different risk profiles and different requirements for offtake, et cetera, but can we say, okay, we are a SAF producer, that's what we're making. We are also building our business case on making some portion of diesel. That's a different market with different credit mechanisms. We are taking some portion and we are going to make RNG. Again, different market, different credit mechanisms, different off-takers, et cetera. We have some solid product that can go into bio-based polymers or some other utilization. So again, I gave some specific examples there, but you can imagine from a bankability standpoint, the more diverse streams of revenue you have and the more different they are from a policy risk standpoint, the more balanced that risk profile becomes, and that can be attractive. So that's the co-product side. And the other one is on the technology bankability. We're a tech company, so maybe we should speak to that a bit. We'll be the first to tell everyone. I know it's early in the meetings when it usually happens. Hey, for a project that's, let's say, 500 million, a billion, you name the number, the technology company is not going to say, well, hey, if it doesn't work, here's your 500 million, or here's your billion. We do a lot of work, and it is our job to get everyone comfortable that it's going to work. We'll continue to do that. Or purely from a financial perspective, we can't back the entire investment, right? The good news is that there are technology risk insurance vehicles that have, there's a maturing market there, real players backed by some of the world's largest insurers to say, okay, there's a gap. The debt provider needs X. The technology company is comfortable with Y. We can fill that gap. It has a cost, of course, but what we've seen is those costs can be manageable in the overall project scheme. And in terms of bankability, those are becoming more and more valuable. So the good news is the vehicles exist and it's maturing. Yeah.
Thank you, David, for adding those two aspects to our discussion. I want to weave in a question from the audience that we got through the chat. And this question is, why does bankability of O&G midstream better represent SAF rather than the downstream bankability? Do we have a volunteer to take that question?
Yeah, and I think I'll take that because I think I mentioned midstream as my usual metrics counterpoint. And the reason I actually pick midstream rather than downstream is really, it is actually fundamentally competing for different pools of capital that you can access. And the reason I point out midstream is that in terms of what these projects are, although from a plant perspective, a lot of what we do looks like downstream, from the investors that we're going after, a lot of them are currently sitting in midstream. There's about 3 times as much investment activity going on in midstream as downstream. And then furthermore, when we're talking about especially project equity participants and the scale of projects that we're talking about, to many of us in the space, a project in $500 million project is a big project. A $1 billion project is a big project. In oil and gas space, that's actually a relatively small project. So a lot of times we're actually looking for smaller investor groups who are currently playing more in the midstream space versus the downstream investors who are frankly looking at projects which are often measured in the 5 to 10 billion range. And that's a different set of investors versus who we actually have to try to connect with as a project developer, which is basically smaller developers who currently have most of their capital deployed in the midstream space. So that's where they're coming from as a point of reference.
Thank you, Jeff. With that, I'll move on to the third part of our discussion points today, and that's the technology pathways. And in particular, which pathways and technologies can efficiently scale, and we can look at that both from a sort of midterm perspective and then also a longer term perspective. And are there any particular factors that hold us back? Jeff, you were just talking, but I think you have a really unique perspective, especially on the power to liquid sort of space. So do you want to talk about that?
Yeah, absolutely. Thank you. And so when I think about the pathways, I think about evaluating the pathways across scaling, the side products, the CapEx, and the feedstocks. And I think it's really important to put this in, again, that broader context of the energy industry. And I think about from the pathway perspective in scaling, we have 3 general pathways. We have HEFA and HVO, we have alcohol to jet, we have power to liquid processes. And I'm going to throw some numbers out here, and you can look on LinkedIn. I'll put this out there again after the call. But when we think about HEFA and HVO, fundamentally, these are similar to fossil refining products. In fact, World Energy, love it. The history of the Paramount refinery goes back to the 1930s. It was a fossil fuel refinery that's been converted to HEFA and HVO. The largest fossil refineries in the world put out 50,000 tons per annum of fuel. The largest HEFA refinery in the world is Neste in Singapore, about 2,600 thousand tons per annum. That's available right now. It's easy to convert assets and just change the feedstocks, and you're running with a HEFA or HVO refinery. Very accessible. Alcohol to jet is called next up. And there we see some great companies doing great work. I love what DG Fuels is doing in Louisiana. Gevo is out there. Lanza is a great innovator in our space. Biggest project that's kind of going on right now is DG out in Louisiana, about 600,000 tons per annum. So about 1/5 the size of Neste, about 1/100th the size of fossil. LanzaJet, Freedom Pines, about 30,000 tons per annum. Gevo plans for about 200,000 tons per annum. Again, smaller scale, measuring now in hundreds rather than thousands. Fischer-Tropsch, and especially power to liquid, I think gets a lot of skepticism. The largest power to liquid refinery right now that's been operating sustainably is the Repsol Aramco project in Bilbao. They're doing about 2,000 tons per annum. So we're suddenly down in single digits. People then add a lot of skepticism to power to liquids. But then I would actually say the Pearl project in Qatar is operating at 7,000 tons per annum. So right back up there, getting into fossil fuel space. And fundamentally in Fischer-Tropsch power to liquid, we're using that those same technologies and reactors as are in use in the Pearl facility in Qatar. And it's really bringing the feedstocks up to those scales rather than the conversion technology itself. Along the way, we've got some other challenges to cross. The side products are really important to understand when we talk about scaling these future products. The polymerization in cobalt-based FT, which is what's been in use since Topsoe Sasol Synjet in '98, that's a really tough nut to crack. And that's actually why Zero is working together with Airbus and Boeing and Rolls-Royce, because basically we have a different catalyst family, a different product set, and we've been able to kind of solve that problem and keep our product in the fundamentally more valuable kerosene and gasoline range versus producing wax as our high yield product. So looking at the side products in these pathways is really important. And the last, I'll talk about the CapEx, which is I think all of us have a duty to figure out how to kind of scale smaller and faster with lower risk magnitudes. A 2 to 5 billion project will always take longer to execute and have what I would call some indigestible project cost changes along the way. If we can figure out how to scale with projects which are a few hundred million in magnitude rather than 5 billion in magnitude, we'll have more success in engineering those projects, absorbing the cost changes that will happen, and then bringing those projects to market. And that's one of my personal steps, is to try to figure out how to scale as small as possible, as fast as possible to forward the technology. So a little bit of talk there on the scaling, the side product challenges, and some of the CapEx issues.
That was super interesting. Thank you, Jeff. Michael, you mentioned earlier on during this webinar the role of policy, the role of regulation. In your view, is there anything that's holding back, from policy and regulatory perspective, pathways or certain technologies? Curious to hear your view.
Yeah, I think at the outset, everybody talks about the best policy being a technology neutral policy. The trick is actually implementing that in a political environment where so many different constituencies need to be satisfied, or they might put a block on something that you're trying to do. I think, I do think I'm a purist maybe in this respect. I think any policy really does need to be crafted to make all technology pathways and providers winners. I know that that's going to be a very tough thing to do, but I think that it still has to be the goal of our collective industry, both in the U.S. And in the world. I do think from a U.S. Sort of focused standpoint, which I think is what this panel is more tailored to. I personally, and it's not a position of Southwest Airlines, but it is a position of the domestic U.S. airline industry. I do think the U.S. has a lot of biomass to make use of, before we reach the point of depletion and panic. However, I do think that depletion, to Jeff will love to hear, will at some point happen. And I think that, we have to be advancing pathways that have a longer lifespan, and create that world where maybe not as much of that biomass is available. But just kind of circling back, I really do think that it's all about creating the policy to make as many people winners as you possibly can make winners. That the trick is how to do that.
Thank you, Michael. Adam, curious to hear your thoughts on technology and maybe thinking about technology in different dimensions, right? Technology related to the production process, technology thinking about feedstock innovation, and maybe even in terms of usage, like how much fuel do the engines really need in the future?
Thank you, Mina. Yeah, so my area of expertise is not so much on the engine and airframe efficiency, although I have worked on that in the past. But in terms of fuels, there are innovations that can happen with established technologies like HEFA. The largest single component of our carbon intensity is our gray hydrogen use. If we swap that out with clean hydrogen, green hydrogen, we can get to emissions reductions of up to 95% with HEFA. So there's a lot of discussion about conversion technologies and only PTL achieving those high levels. You can actually refine existing technologies and drill down, and the engineers, through knowing by doing, are improving the processes and getting better yields and improving the performance. So it's also important to use this established technologies, and that's one of the reasons why World Energy has supported HEFA. Another piece that connects with bankability is that banks are wary of taking on technology risk. So they prefer to invest in the technologies that have been proven. And so we know that HEFA is limited, and it will, even under best circumstances, not cover the majority of SAF demand in the world eventually. But the innovation can happen with the feedstocks for HEFA. So we can increase the yield beyond waste oils. As Michael said, there's an ability potentially to cultivate and use some of the biomass in North America that could be available. Granted, if we can implement the sustainability requirements necessary. But also there are innovative areas where we might actually be able to obtain feedstocks from degraded or contaminated lands. So this looks like a large opportunity that World Energy is pursuing, is that how do we create a supply chain where there may not be an ag system in place? Where do we build the infrastructure so that we can start to take on feedstock that can provide also a benefit in terms of mitigating or cleaning up areas that may be contaminated from PFAS, et cetera. And then we also think that as the sector matures, there'll be greater demand and durable demand for intermediate crops, otherwise known as cover crops like Carinata and Camelina, which will also be cultivated and intentionally grown that will support HEFA. So please keep watching the HEFA space. Innovation can still occur within established technologies, and in fact, they're critical to help get us to scale.
Thank you, Adam. David, I know you also have thoughts on feedstock innovation. Do you want to add to what Adam just shared?
Yeah, I'd say just to double down on it mostly. We've all known that feedstock availability is one of the long-term constraints for HEFA. I use quotes there because HEFA, hydrotreated esters and fatty acids. It has that name because a certain set of molecules. But if you zoom out further, and Jeff, you said it, for example, the World Energy facility used to be a refinery. It's really hydrotreating. We zoom out far enough. It's catalyst hydrogen to get the molecules that we want from the molecules we have. And the good news there is that because the market and all the players have known that there's the potential to have a constrained feedstock situation, folks have been working on how do we expand that. Adam mentioned cover crops, and these are things you can grow and use, and the feedstocks look a lot like we have today. There are also players who are now maturing because this conversation has been here for a while, and they're getting to the place where they're building demo plants. And soon we can start thinking about real supply of things like lignans, which is solid biomass that's esterified, and that can be hydrotreated. And that's another, again, it's not necessarily a HEFA, but it's a hydrotreating to make the same molecules in the end. Folks working on volatile fatty acids and producing ketones a ketone, as long as it has the right carbons, we can hydrotreat it and we can make the same molecule. So those are just two examples of using the same types of assets, the hydrotreating asset, to make more SAF, middle distillates, etc. Yeah.
Thanks,
If I
David.
may,
Yes, please.
Amina, if I may, so first I want to recognize today was actually a really good day in global energy policy with the announcement of the investments in nuclear between the USA and UK. And nuclear energy is really important to many of us because it is actually a really easy and predictable way to make green hydrogen in all of our processes, whether we're power to liquid, HEFA, or alcohol to jet, leverage hydrogen as part of our process. So green hydrogen accessibility is really important. There's been a lot of hype about it. I think we're right now in a little bit of the valley of despair. But then long term, I think there is still a lot of optimism for green hydrogen. When we think about power in general, ultimately solar will be a superb source of energy. And when you think about solar as a source for PTL, you can plant solar panels on the same field as you plant another cover crop and actually yield 20 to 30 times more energy on a conversion basis from solar energy to liquid fuel via PTL versus pushing some of those things through a crop cycle. That is a longer term play, and other things have to improve to get there. I'm going to be very realistic on that. We would have to work on electrolyzer utilization and cost per kilowatt and such. But at the end of the day, I think what I want to leave that with is there is for me very much a sense of optimism on feedstocks. We hear a lot of negative news, but whether it's the diversity of feedstocks and lignans and other cover crops, as Adam mentioned, or whether we're talking about bagasse and other forms of second generation alcohols, there are a lot of options coming. So I think we want to look through some of the hype and despair and say long term, there are ways to solve our feedstock challenges.
Thank you, Jeff. I'm taking now a question that we received from the audience. And this question asks, what mechanisms and structures are successful in driving early stage project development and engineering? Of course, with the goal, right, to get commitment to off-price term and pricing. Anyone would like to take that? Jeff, can you speak to that?
I think actually, I think David actually brought some good points there in terms of technology risk and reinsurance. I think the other part here is that sometimes less spoken about is the importance of EPC and what we would refer to as the balance of plant packages. And I think when we think about being technology developers, a lot of times inside our four walls, we focus on one very small aspect. But then the reality is bringing these projects to market takes very large scale engineering. At Zero, we're working with Technip now to actually accomplish this for one of our next scale plants. And I would say very much look to the role of large EPC to help the industry grow and help get these projects to successful execution.
Thank you. Anyone would like to add to that before I move on to the next question?
Yeah, maybe a couple thoughts. One is mostly a joke, but there's some truth to it, which is wealthy friends and family doesn't hurt, which is, we know that at early project development, especially at the very beginning, FEL zeros and FEL ones, it's risky. It's risky capital. And that market is maturing, but let's say it's not easy to just go out and say, hey, I need $20 million to go. And that's where, you mentioned it before, Mike, that while the airlines are saying, hey, price parity is really plus or minus what we're looking for, they've been such key players here. Even if price parity is what they're looking for, they're just such an integral part of the conversation in terms of helping get through that initial risk capital, whether that's for technologies that are developing or projects themselves. So let's say looking at industry stakeholders and then joke about friends and family, it doesn't hurt because that's the riskiest money in the very beginning.
Thanks, David.
Yeah.
Adam, I have a question for you, and this goes back to sort of the more conventional technology and use of HEFA. What is your view on sort of a competition between renewable diesel and then actually producing SAF, which is our topic here?
Yeah, it's a great question. So if people may know, you get a higher yield of fuel if you concentrate on making RD as part of your process. So you've got more product to sell. You potentially need less hydrogen. There are so cost benefits from the production cycle. And then in the United States, diesel often sells for more than jet fuel. So you've got price preference there. It is a challenge right now if you're looking at the economics and you want to maximize your SAF yield and you're a producer and you have the option to do RD and you're making a decision. It often looks like RD is a better choice. It depends right on our market conditions and those fluctuate. But right now, there aren't as many strong levers as we would like to favor sustainable aviation fuel. And we know that the road sector has other options. And there are disruptive technologies that are coming. People are familiar with Revoy. It's an electric hybrid system that goes onto the back of conventional tractor that can actually be used today and is being used, and it saves over 85% of the diesel fuel. So the disruptions are coming. They may not be full electrification of long-haul trucking tomorrow, but maybe the next day or soon. And I think producers need to think about how they're going to shift to SAF. Right now, the signals are not as strong as we would like. So there is competition, but in the longer term, we know where we need to go. So there need to be commitments from the investors to see us through so we can maximize the SAF yield. But yes, very much that this is a current topic, though we think at World Energy that in the long run, sustainable aviation fuel is going to be the focus.
Thanks so much, Adam. I think that's actually a great way to close the panel. A huge thank you to all four of you. You have offered very interesting insight, from your different perspectives. With that, I close the panel and turn it over to Ross.
Thank you very much, Amina. And I just want to echo you and say a huge thank you to our panel, to all of our attendees, and especially to Adam for persevering through some computer restarts. So thank you very much. To all of our audience, if you'd like to learn more about everything that was discussed today and hear more from all of our brilliant speakers, please make sure you join us in Houston on October 14th to 16th for the SAF North America Congress, and go to www.sustainableaviationfutures.com for full details of all of our events. Thank you all again, and I hope you have a wonderful rest of your day.